So today I'm going to discuss about 5 or 6 key financial indicators that petroleum economist uses to evaluate the effectiveness of any upstream oil and gas projects. Actually, we can use these matrices in any of other financial projects as well, not just oil and gas. But let's just stick to the oil and gas, and those 5 key indicators are: the first one is NPV, which is net present value of the project. This indicator tells you what is the total value of all the future cash flow that is going to be generated by undertaking this current project that we are evaluating. The second indicator is IRR, which means if we invest in this project, then what is the return that we are going to make by investing in this project, whether it is 10%, 15%, 20%, etc. These projects are of a very long-term nature, so the investor or the management must know what is the expected rate of return, and that rate of return is calculated using IRR. The third key indicator is payout or payback period. So if I'm going to invest in a project, knowing that it's a risky project and it can take many years before the oil is discovered and produced, so I need to know how many years it will take for me to recover my initial investment back, and that is called payback or payout period. The fourth one is called capital exposure, or MCE, or some people call it MCO, maximum capital outlay, or maximum capital exposure, MCE. This is the amount that you need to have upfront in your pocket before you can invest in this project. Let's say you have upstream oil and gas project where you have to explore and then find oil, and then once you have found the oil, then you need to develop the field, and all this needs money. So maybe during the exploration you need 100 million, and then once you have found oil, then probably you need another 500 million, and during the development phase you would start producing at some point. From that point onward, once you have started producing, then you don't need possibly external financing, because the project would be generating cash flow for you, and you can finance the subsequent capex from the cash flow generated from the project. Therefore, you only need to know how much is the money that you need before any first oil is discovered, and that amount is called maximum capital exposure. The fifth indicator is called DPI, or discounted profitability index. This is a ratio of your NPV versus the present value of all your capex. So basically it tells you in present value term, for every dollar how much money you're going to make. So if you're investing, let's say, $1 of capex, then what's the profit in present value terms that you're going to make from this project? So this number DPI should be more than 0. If it is negative, that means for every dollar you are losing money. If it's positive, that means you are gaining money. There is another indicator which is very similar to DPI, but it doesn't account for the time value of money, and it is a very simple indicator. This is called cash on cash, or money on money. So if I put in $1 today, how many times do I make money in return? So if I put in $1 and the project generates $3, that means I have made $2 by investing this $1. I put in $1, I get back $3, my profit is $2. So the cash on cash here is, for every dollar I put in, I'm getting back 3.